Hey everyone, Coach Investor back on our 4 stocks to buy or watch in a certain month. We're already in the month of November, so that means 2 months left in 2023. Pretty crazy how fast this year has gone by. Now, this video, I've chosen 4 stocks and companies actually that have already reported their quarterly earnings. So there's no confusion. Maybe during the week, a certain company will report and then suddenly the stock is up 20% or down 20%. And then people ask, is it now a buy? Is it not? Is it worse? Etc. etc. So all the companies in this video have already reported earnings. Yes, some of the companies are, again, a bit of a boring choice, but that's just because the stock price has gone down a bit. Earnings were pretty good and overall just great companies. So, hey, I'll just repeat the same thing over and over again. Now, of course, these are just 4. There are plenty of other great companies that you could put on your watch list or put in your portfolio. Of course, do share yours down in the comments below. Company number 1 I want to talk about is a company I've never touched on this channel actually, and that's a cybersecurity company. Fortinet. Now you might say, oh, you're going for Fortinet. That's just because, well, the stock is down, bad earnings, so you think this is a bargain. Well, first of all, if you look at the 3-year mean and the valuations right now, yes, it does seem like a bargain. Even if we look at the 5-year mean and PE, next 12 months, EV to EBITDA, price to sales, price to free cash flow in the last 12 months, yes, you could clearly see that currently the stock is trading at a much cheaper valuation than what it is used to. Now that said, there could be a reason for that. Fundamentals are down, the company's business is not doing great, the sector isn't doing great, but in my opinion, cybersecurity, that sector is doing quite okay, and that sector will just become more and more important as most of our things in life will become digital. They'll need cybersecurity. Now, with regards to Fortinet, it's also selling hardware, so it's a bit different there. And well, with most people looking at the big cloud players for their cybersecurity solutions and stuff like that, there is going to be a need of a shift with regards to Fortinet, which they know, they acknowledge that. We're going to have a look at the quarterly earnings in just a bit. They made a couple of comments, and so that will take some time. That's why also the stock has come down. Lots of downgrades because analysts acknowledge that this change is going to take a while. But overall, you cannot tell me that this doesn't look great. This is over a now 5-year period. Revenues continues to go up, free cash flow positive every single quarter, return on equity insane. Gross profit margin, yes, has come down, but has picked up a little bit in the past couple of quarters. Return on capital continues to go up as well. So yes, I do see some value in this company right now. And so if we go and look at the 3rd quarter earnings, we can see the following. Total revenue up 16% year over year, service revenue up 28% year over year, billings just up 6% year over year. But with the rest, GAAP operating income, that's up 14% year over year to $303.2 million. If you look at operating margin, 22.7%. Free cash flow, $481.1 million. Cash flow from operations, $551.2. And here comes the comments. So while the secure networking market is experiencing slower growth as product demand returns to normal levels following 2 years of elevated growth, we are leveraging our scale go-to-market capabilities and engineering expertise to focus our attention on the faster-growing secure access service edge and security operations market, in addition to continuing our focus on secure networking. Of course, all of that will take some time to actually materialize, and you will be able to see some growth in their earnings report. Because if we go scroll down and look at guidance was a miss of expectations below what the market analysts were expecting. So for the 4th quarter, revenue in the range of $1.38 to $1.44 billion, and then billings in the range of $1.56 to $1.7 billion. I believe expectations was 1.72. So of course, a miss like that, in the current market environment, yes, you will get punished. A bit of weakness in guidance especially, and the market is punishing you a lot in the current market's condition. But overall, again, if you look in the last 5 years, free cash flow per share continues to go up. The estimates, the EPS estimates with the 5-year growth rate sits at 17%. Shares outstanding have also come down in the last 5 years. Yes, it has gone up a little bit this year, but hey, in the last 5 years, in the last 10 years, you can clearly see that they are buying back their shares. Free cash flow goes up, And so, yes, in the meantime, the stock is hurting, but the business is financially healthy. And so if we go and look at the graph, if you are not familiar, this is not the first time that this stock drops heavily after a weakish earnings report. We had the same thing back in July, and now we're sitting at $50, which has been a zone of support-ish in the back half of 2022. And you can also see that we were actually down way more. We're down to $44. There has been a lot of buying action, of course, in the last 2 days of last week. So that definitely helped pick up the stock a little bit. RSI is weak low, but not oversold just yet. So that's stock number one, Fortinet. Of course, do share your thoughts down in the comments below. Do you own it? Is it also on your watch list? Let me know down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe. If you have not, would really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. All right, moving on to stock number two. It's my number one position. Yes, I know it's pretty boring. Again, the same company. Yes, again, the same company. Unfortunately, this video was supposed to be out a bit earlier and the stock was a bit down. Well, now not anymore. We're back at $220. And yes, I'm talking about Tesla. I was planning on doing this video coming out November 1st, but since it was full-on earnings week, completely forgot about it. The stock was back then a bit under $200. Yes, we're up 10%, but hey, if you want to hold a stock for a long period of time, 10% shouldn't really make the difference. Market cap just under $700 billion. Forward PE 60.5 times. If you watch the Tesla weekly video, you've probably seen these numbers already. Today, compared to its 5-year means, yes, PE is lower. Yes, EV to EBITDA is lower. Yes, price to sales is lower as well. The only one that is more expensive right now is price to free cash flow. We know why that is. Free cash flow for Tesla has been going up, down, has not really been a constant for a couple of quarters straight. But overall, yes, you are buying a company that is in a, let's say, difficult environment right now because of high interest rates, not because of the fact that they're not advertising, because if that was the case, then the competitors, the competition who advertise for billions of dollars would not have the same issue. But no, Tesla is still selling a lot of cars in a lot of markets, still has high margins despite seeing some slowdowns in their margins. As you can see right here, total GAAP gross margin year over year, it's down 719 basis points, still 17.9%. We know that the energy business is now the higher margin business of Tesla, which again is just the start. Yes, it's still just small parts of the overall company, but hey, if the margins today are already that high, I mean, imagine when that will become a huge business, the things here will only go up. Operating margin, yes, has come down 964 basis points to 7.6%. I know, not great at all, especially since those 17.2% back in Q3 2022 or 16% back in Q4, it has come down consistently. Yes, when you reduce the price of your car so you can sell more cars, then eventually you can sell software. This is what is happening. Tough times, you take drastic measures. Now, believe it or not, when interest rates will go down, expect these margins to go back up. But overall, total production is up 18%, total deliveries up 27% year over year. Storage deployed up 90%. Yes, solar, we've talked about solar with Enphase, Solar Edge, and Tesla. That is still a very small part, and it's also down 48% year over year. But overall, big picture here is this. Market share of Tesla vehicles by region continues to go up. The roadmap here for new models coming out, Cybertruck, ramping up of Tesla Semi, Roadster, whenever that will be done, and then the next gen platform, also probably in the next 2 to 3 years or so. And this is the car that will sell for millions with probably a good margin as well. Of course, this will not happen overnight. I know, I've been with Tesla since 2019. So yes, I've seen the company struggle a lot, but then, I mean, it's been up and up and up from there. And so if we go back and look at the graph, as I said, a couple of days before I wanted to make this video, it was just under $200. We got some buying action towards the end of that week. We're now sitting at $220 or so, which was a previous support line back in August. Remains to be seen what happens. 200-day moving average is still at around $230. RSI is still pretty neutral. Up next, company number 3, stock number 3 is a company I do not own in my personal portfolio. I used to own it in the trading one when I called it the opportunity of a lifetime when it was under $100, and that's Alphabet. Now we're back at $129, market cap $1.62 trillion, forward PE just 20.2 times. Year to date has been performing quite well, 46.3%. And I mean, if you look at valuation wise, we're still pretty cheap-ish. I'm not going to say extremely cheap like we've been at the start of this year, but hey, PE next 12 months 20.2 times compared to a mean of 24.8 times, EV to EBITDA 11 times compared to 13, price to sales, that's a bit high actually, 4.9 compared to 5.3, price to free cash flow, that's in the last 12 months, 20.9 times compared to 28.8 times. But with Alphabet, I strongly believe that you will get a lot of value in the coming years because of them buying back billions of dollars worth of their own shares. It's going to be a bit of the same thing as what you've seen with Apple, for example. But with Google, Alphabet, you're also getting growth from the business, not just from those buybacks or from that dividend payout. Now, if we go and look at their last earnings report, it was a very, very good earnings report despite the drop because of the cloud business, which disappointed a little bit. If you look at the revenue, that's still okay. But if you look at operating income, not that great. It has grown slower than what the market was expecting. And again, a little bit of weakness in this market and you're going to get punished. Now, I'm not the one that's going to repeat it over and over again, but I'll repeat it in this video anyways. The Google Pixel phone is going to be a huge, huge success for this company. Mark my words. I've been saying this for a long, long time. Mark my words, Google Pixel is going to take a lot of market share. Now, of course, you're not buying Alphabet just because of the Google Pixel phone, you're buying for the whole package. YouTube, Google Network, services, advertising, cloud, you name it, and then the other bets as well. But I mean, if you know the Google graveyard, you know that a lot of bets never actually materialize. But overall, when you buy Google, you're buying a business that will probably be here for years and years. And for those of you that are already writing in the comments section below, but what about XAI's Glock or Grok or whatever, ChatGPT, you name it, competitor? Can it hurt Google search? Are we going back to the Bing is going to destroy Google search type of scenario? I'm not going to repeat myself again. Anyways, looking at the graph, what we've seen here is a clean recovery from that 200-day moving average after the earnings report. Stock was around $120. Bim, little rebound there. RSI still pretty neutral. I mean, yes, the top could have been 140 for a while, but anything around that 120, if it can go lower, great, even greater pickup. But for years and years to come, you're going to get a lot of value from holding Alphabet. And so we've reached company number 4, and that's a company that's pretty popular right now because of the risk reward, because the stock has come down so much, and because the business itself, surprisingly, is not doing as bad as what the headlines would tell you. And that's PayPal. Yes, I know I'm again talking about PayPal. Yes, because the opportunity is so big. It's not in my core portfolio, but it is in my trading portfolio. That means that I'm still going to hold this for the next 3 to 6 months. And hey, if the business becomes better and better and I like it, I mean, maybe it will have a place in my core portfolio. Currently, $56, market cap just over $60 billion, forward PE of just 10.4 times. Yes, this is not a high growth company right now, but if you go and listen to the earnings call, I'll make a specific video talking about the most important points that were mentioned during that call, first call with the new CEO. Very, very exciting, but as I said on Future Investing's channel, good talk, good speech, but now it's time for execution. Of course, we're going to give the new CEO some time. He cannot work his magic in a couple of weeks, but already some promising signs. Now, purely looking at valuation here, this does not make any sense. price to earnings, EV to EBITDA, price to sales, all much, much lower than the 5-year mean. Of course, we had that huge bump during the pandemic time. So yes, take that into consideration. But if you want, we can go to the 10-year mean. Doesn't really change that much. We're still extremely cheap compared to the past. And if we go and look at the Q3 highlights, net revenue, like I said, this is not a high growth company currently. Net revenue increased just 8%, operating income 4%. EPS on a GAAP basis is still down 19%, but non-GAAP is up 20%. But in my opinion, you're buying this company because it will become more and more profitable over time. Margins are going to expand. That's what they said during the earnings call. Of course, it's going to take some time. Even with Braintree, we might see some margin improvements there. I don't know when that will happen, but it has been mentioned, so that's already pretty promising for me. Then in the past video, I highlighted this transaction margin is still coming down, but it is coming down much slower than before. For example, we went from Q1 47.1% to 45.9%, so quite a biggish drop, but then just 0.5% down quarter over quarter. In my opinion, we are seeing a slowdown in that margin loss. Maybe we will see a little rebound sooner rather than later. Payment transactions per active account has actually increased quarter over quarter, so that's also a good sign. And just like with Alphabet, you're going to get a lot of value from PayPal buying back their own shares, especially since they generate billions of free cash flow each and every year. And if the stock remains extremely cheap, expect them to buy more and more. And so your shares will become more and more valuable in the future. And so finally, looking at the graph, we got that rebound here at around $50 or so, which was the lowest point since May 2017. Now we had that big green candle just above that 20-day moving average. The next stop will be $60. That was previous a support line. So in order for us to go back up, we have to go and break that $60 mark. Whenever that will happen, I don't know. But I mean, this business is still doing extremely well. Yes, a bit slower than before. Yes, a little bit less profitable than before. But for it to be priced in at just 10.9 times forward PE, it just doesn't make any sense at all. And so, yes, it had to be in the list yet again. So that will be it for this video. Of course, do share your thoughts down in the comments below. Do you own any of those companies? Are those also on your watch list? Let me know down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.